how to avoid paying capital gains tax using the 6-year rule. In the next few minutes, I'm going to show you exactly how Australian property owners like you can legally avoid paying capital gains tax, sometimes saving $100,000. How? By using a strategy called 6-year rule. I'm Ash from ClearTax, and over the past year, we have reviewed more than 1,500 property tax returns for Australian investors. What shocked us was how many property owners we worked with were either unaware of the 6-year rule or had misunderstood it and ended up leaving tens, sometimes hundreds of thousands of dollars on the table. Just last month, we helped a client save $127,000 in capital gains tax using this exact strategy. And the best part, it's 100% legal and backed up by ATO. Here is what we are going to cover today. First, I will explain exactly what capital gains tax is and how it's calculated. Then I will break down the 6-year rule and how you can use it to avoid CGT. Finally, I will show you things that may trigger ATO audits and how to avoid them. So let's dive in. I will start with the foundation. A capital gains is the difference between what you paid for the property and what you sold for it. So let's say you bought an investment property for $500,000. A few years later, you sell it for $800,000. You have made $300,000 of capital gain and you will need to pay tax on it. The ATO call this capital gains tax, or CGT for short. Now, CGT isn't actually a separate tax, it's just added to your assessable income for that year. So, if you go back to my first example, if you sell that property within the first 12 months of owning it, the entire $300,000 gets added to your taxable income. That means if you are already earning $150,000 as an employee, suddenly you are paying tax on $450,000 that year. Ouch. So here is how to fix that. If you hold the property for more than 12 months, you get what is called 50% CGT discount. That means only half of your capital gains is taxable. So using the same example, if you sell after holding for more than a year, only $150K of $300K gains gets added to your taxable income. You are earning $150K from your job and you will pay tax on $300K total instead of $450K. That's already a massive difference. Now, I will mention here that capital gains tax only applies if you're selling an investment property. If the property you are selling was your main home and the place you actually lived in, you don't pay any capital gains tax when you sell it. That's completely exempt because you are not generating an income. This is an important point because there is still a way you can avoid capital gains tax altogether even if you're generating income from a property for a period of time. This is where the 6-year rule comes in. Here is how it works. Let's say you bought a home in Melbourne in 2018 for $600,000 and lived in it as your principal place of residence for 1 year. Then because of work or family reasons, you had to relocate to Sydney in 2019 and you moved out, starting renting in Sydney and deciding to rent out your Melbourne property to tenants. The market value of your home as in that point in time was $650K. Normally, that Melbourne property would now be considered as investment property, which means when you eventually sell it, you owe capital gains tax on the proportion of time it was rented out. But here is the best bit. Australian government allows you to treat that property as your principal place of residence for up to 6 more years after you move out, even though you're renting it out and earning income from it. This means you can rent it out, collect rental income, claim deductions, and still pay 0 capital gains tax when you sell, as long as you sell within 6 years of moving out and don't treat your other property as your principal place of residence in that period. So fast forward to 2024, you decided to sell the Melbourne property for $900,000. You have made a $300,000 capital gain. So you live in it for 1 year, rent out for 5 years, total owing it for 6 years. Because you are within that 6-year window, the entire property, it's still considered your PPOR, meaning you pay 0 capital gains tax on $300,000 gain. But what happens if you go beyond 6 years? If you exceed 6 years of renting it out, the exemption becomes prorated. So let's say you held the same property for a total of 10 years. You lived in it for 1 year and then renting it out for 9 years. Now calculating the CGT, after you have exceeded the 6-year rule, the ATO only looks at the rental period, not your total ownership. So in this case, you rented it out for 9 years. 6 of those years are covered by exemption. That leaves 3 years taxable. That's 3 out of 9, which equates to 33.33% of your capital gains that's taxable. Now, here is the other thing. Your capital gains isn't calculated from your original purchase price anymore. It's based on the market value on the day you first rented it out. So if you bought the property for 600,000 in 2018, but when you started renting it 2019, it was worth 650K, that 650K becomes your new starting point for CGT purposes. Fast forward to 2028, you sell it for 900,000, your capital gain is 250K, not 300K. 33.33% of that 250K is about to be 83K, that becomes taxable. And remember, you are still get 50% CGT discount on that amount because you held it for more than 12 months. So your assessable capital gains drops to roughly 41,500. But here is what gets even more interesting. You can actually reset the 6-year clock. And this is one of the most powerful aspects of 6-year rule. If you move back into your property and re-establish it as your main residence, the 6-year clock resets. Let me show you how this works. So let's say you lived in your Melbourne property for 1 year, then moved out and rented it for 5 years, and you are getting close to that 6-year limit. So you decided to move back into that same property for a year. After living in it again for a year, you move out and rent it out again. Guess what? The 6-year clock starts again. You now have another 6 years of CGT exemptions from that point forward. This means you could potentially hold and rent that property for decades and still avoid or minimize capital gains tax, as long as you move back periodically to reset the exemption. But this is critical. Your intention has to be genuine. You can't just change your driving license address, throw some furniture in the property, call it your PPOR for a few months to game the system. The ATO is very good at sniffing out schemes. And if they determine your intention was purely to avoid tax rather than genuinely living in the property, you are going to a very uncomfortable audit. So how do you prove to ATO that you genuinely lived in the property? What documentation do you need? And what are the biggest red flags that trigger an audit? Well, the ATO doesn't just take your word for it that the property was your main residence. You need to prove it. And to do that, you will need the following pieces of evidence: your driving license, address, where you are registered to vote, utility bill in your name at that address, where your kids go to school, where you work, how far the property is from your workplace, mail and correspondence going to that address. Now let's talk about what not to do. The biggest red flag for the ATO is if your intention looks like tax avoidance rather than genuine residence. The most common ways to trigger an ATO audit are buying a property, claiming it as your PPOR, but never actually moving in, doing major renovations immediately and flipping it for profit, changing your address on paper, but never actually living there, moving in and out repeatedly in short time frames without a genuine reason. The ATO looks for patterns. So if it looks like you're buying and selling properties just to claim the PPOR exemption, they are going to investigate it. But if you are having genuine circumstances like relocating for work, family reasons, downsizing, or lifestyle changes, and you can document them, you are in the clear. Now you know exactly how the 6-year rule works, how to reset it, how to prove your residency to ATO, and how to avoid the traps that cost investors thousands. This is one of the most powerful and most underused tax strategies available to Australian property owners. And if you're planning to relocate, upgrade, or rent out your home, understanding this rule could save you a 6-figure tax bill. So here is what I would recommend you should do next. If you are serious about minimizing capital gains tax and structuring your property portfolio the right way, don't try to figure this thing out on your own. So if you'd like to speak to an accountant, I have left a link in the description box to book a strategy call with our team. Thank you for watching, and I will see you in the next one.